it's a good idea to read the disclaimer that's up on the screen. And if you can hear me, just type a Y either in the chat box or in the question box. Perfect. So I'll give you a few seconds to read this first important disclaimer. And there's one more disclaimer about hypothetical performance. And I will, I tried to turn my microphone up, so hopefully that's a little bit better for Nick and Colin and some other people. Perfect. Okay, well, let's get started. I'm Kevin Davey, KJ Trading Systems, and today we're going to talk about some best practices for creating algorithmic trading strategies. So first, I'd like to thank FXCM for sponsoring today's event, and that's probably how you heard about it. So thank you to them. And there's one more disclaimer. This is a U.S. government disclaimer, and you should take a few seconds to read that. And one of the big things, and you saw it in the earlier disclaimer, is about hypothetical results. My rule of thumb is if the results didn't happen to you, treat them as hypothetical. And if you use that approach, you're usually pretty good. Just treat everything you see with some skepticism, every kind of equity curve and everything like that. Okay. So before we get into who I am and talk about things, I am recording this, and I believe it's going to be posted on YouTube afterwards. And if you have questions, feel free to type them in at any time. I probably will not answer any until the very end. And if you have any questions for FXCM, they will answer those separately. So, you know, encourage questions. I'm going to hit them at the very end. Okay, so who am I? For those of you who don't know me, I'm a full-time trader, and then I also write and do some consulting part-time, and I've been trading about 25 years or so. And the last 10 years, I believe, I've been doing this full-time. So I was able to make that leap from part-time trader to full-time trader, you know, that everybody kind of gets excited about, that I want to trade full-time. So I was able to actually do that and kind of live the dream. And then in 3 years straight, I was able to finish in first or second place in the World Cup of Futures Trading Championship. You may have heard of that contest. That was the one that trading legend Larry Williams a while back turned, I think it was 10,000 into over $1 million. And that's real money. It's a year-long contest. So you go up against some pretty good traders. And I finished in first or second place with over 100% annual return each year. And then a few years ago, I wrote a book published by Wiley. It's called Building Winning Algorithmic Trading Systems. And it's still up near Amazon's bestseller list. And it's a pretty good book if you're wanting to learn how to do algorithmic trading. And it also has a beginning part where I talk about all my failures, which take up a lot of the book, unfortunately. But pretty much everything in trading that could have been done wrong, I did wrong early on. And so, you know, if nothing else, you could read that and understand what I did wrong. And speaking of the book, I'll be giving away an autographed copy to an attendee, and I say an attentive attendee because I'll have a question at the very end. And if you answer it correctly and you're the right number person, I'll send you that book. And you know, even if you're not in the U.S., I'm in the U.S., but I'll send it to you no matter where you are in the world. So you'll get that. So stick around for that. So besides writing the book, I also, as I mentioned, I do some consulting and teaching. I teach an online class. It's called the Strategy Factory Workshop. It's gotten pretty good reviews and won some awards. So it's just something to think about if you're really looking to get into algorithmic trading. So today, that's exactly what I'm going to talk about, is algo trading. And I'm going to talk about some of the best practices and some things you should be doing. And I'll probably throw in some things you shouldn't be doing if you actually want to do this algorithmic type trading. Unfortunately, most people, when they hear that, they hear the word algo and they start to get all nervous. You start to think of robots and things you don't really understand. In the US yesterday, there was a fatality with one of those self-driving cars. It was the first ever fatality. So, people hear that and they think, wow, well, something was wrong with the algorithm because it let the car hit somebody. And, people run for the hills, and especially in trading. The word algo kind of has this scary connotation. And a lot of that's because people associate it with high frequency trading. And I'm sure you've all read the stories or read the books about high frequency trading and how they're cutting out, obviously they cut out all the floor people and they're just, taking everybody's money. Well, and that's true. That's definitely true. So my response to that is just don't play their game. The high frequency people make hundreds of trades or thousands of trades a day. They're in and out, scalping for ticks here and there. So they're pretty good at it, right? Because they have the infrastructure, they have all the equipment, and they're co-located, and they get in front, and they do all these things to make sure that their orders get in the front of the line and get filled first. So for you and me as retail traders, really the only thing we can do is just stay away from them. And what I mean by that is if you're going to try to trade 100 times a day or 1,000 times a day or even 10, 20 times a day, you're going to have a tough time. Because just remember, these high frequency guys are going to be on the other side of a lot of your trades. And so trying to get real tiny profits is going to be very difficult. So I tend to look at a different realm, which is longer term trading, maybe days to weeks, where you don't trade as much. And that seems to work out better. But when you talk about algo and algorithms, it's really just a terminology change from years ago. Years ago it used to be called mechanical trading, systematic trading, rule-based trading. Some people call it quantitative trading. There's a whole bunch of different terms for it. But really what it comes down to it, and the way I define it, is an algo is just a set of rules that determine when to trade. So they can run on the computer and tell you when to get in, when to get out. And you can automate that and just let it run, which is kind of neat. But that's not all algo trading. Somebody who calculates moving averages by hand with a little calculator, that's an algo, right? Because it's a set of rules that allow you to buy and sell, and they tell you when to buy and sell. And this isn't a picture of me, but this was way back when I started. I didn't have a computer. This was more than 25 years ago. So I actually did it by hand, and I calculated moving average crossovers and on a sheet of paper with I don't know how many columns. I think it was 4 or 5 columns, and I'd get the closing prices every day for all these commodities. That was an algo, They didn't call it that then, but that was algo trading, because when there was a moving average crossover, I bought or I sold. So that guy is algo trading. And then a PhD statistician who's, you know, writing 1,000-line code for a hedge fund, he's obviously algo trading too. So there's some different aspects to it, and there's some different levels of algo trading that you can still consider algo, right? So the way to think about it is algo is just a set of rules to help you trade. So you can't be intimidated by that. I mean, everybody, whether they know it or not, has some rules to trade by. You know, discretionary traders have rules to trade by. Now, they might not follow them all the time. They might change from day to day or hour to hour, you know, depending on what they see on a chart. But somewhere they do have a rule. Now, the nice thing about algo trading is if you set it up, the computer will follow the rules and you don't have that variation. So there's some benefits to it, and we'll get to those in a minute. All right, so the first best practice, and I'm going to give you a bunch of these. Make sure you want to algo. And what do I mean by that? You know, well, of course I do. I'm here, right? Well, algorithmic trading is not easy. No trading's easy, right? All different types of trading is all difficult in its own way, whether you're trying to stare at a chart to figure out patterns, or you're trying to program strategies that are successful. You got to really be committed. And if you're not, you know, if you just kind of go in with, you know, oh, half a motivation that I'm going to try this, and, you know, you're the kind of person that gives up after a little while, this isn't for you. This, if you want to be successful at this, just like if you want to be successful in anything, right? You've got to make sure you actually want to do it, and that you're going to want to spend the time and effort to actually learn algorithmic trading and actually practice it. So, you know, even after all these years of me doing it, I still am developing systems. So it's not like, oh, hey, I developed 2 algos to trade crude oil and I'm done. I can just sit back and watch the money roll in. Well, it's not like that. You know, some people will tell you it's like that, but it's not. So that's the first best practice, is make sure you actually want to do it, and then you commit yourself to doing it. So some reasons why, you know, you might say, why should I consider this at all? Some reasons it's nice is you can test whatever your rules are historically before you put real money on the line. And that for me is a huge thing, because you find out most things don't work. You know, most things that are out there in books and magazines and on the internet that say, oh, hey, you got to do this system. When you put it to the test, most of those don't work. And that's an eye-opener, because what a lot of people do is they find something and they just go and start trading it. And I've done it myself, so you know, I'm not saying I haven't fallen for that, but I remember getting a book once and seeing this really cool system, and I immediately started trading it and started losing money. And then I went back and tested it and found out, well, the historical back test was awful. So it never made money. Now, you could argue, well, maybe I was programming it wrong and the book author was still right. I don't know. All I know is what I tested didn't work, and that was what I was trading. Well, algo trading is a nice way to test it before you actually get committed to it. And then you can create multiple strategies. You can get diversification. That's huge. The diversification is probably the closest thing to a quote unquote holy grail that is out there, because you can trade gold and crude oil and soybeans and the mini S&P, and you can trade them all at the same time, and you'll get some diversifications. And then the third point is it can be psychologically easier than discretionary trading. Not to say there's no emotion. You know, if anyone ever says, hey, algo trade, there's no emotion, they're lying, or they've never traded. Because as long as you have real money on the line, you're gonna have emotion. So, but psychologically, this type of trading can be easier, because once you set it up, hey, you just follow the systems and what they do. You know, you don't overrule them. So it can be easier. It can also be more difficult. And I already mentioned that red point. It doesn't eliminate emotion. So please don't think it does, because you still have emotion. I'll give you a quick story. There was a guy I met I'm in Cleveland, Ohio in the US. And there was a guy who was on the other side of town, and he found me, and so he said, hey, let's meet for coffee. So I met him, and he wanted to show me this forex system he came up with, which was really cool. And you know, he said, hey, I'm going live with it. What do you think? I said, well, just follow your rules, you know, if you've tested it. So at the end of that week of him going live, I contacted him and said, how'd you do? He goes, well, I made $500. And I knew he had a $5,000 account. I'm like, hey, that's pretty good, 10% in a year. And he said, yeah, but I got scared in the middle of the week because of some announcement, and so I turned my system off. And long story short, I would have made $2,500 had I just stuck to what I had tested. And that's a key example of emotion upsetting your algo trading. So it can happen, and that's important to keep in mind. It can be very frustrating. I can't tell you how many ideas I test that I just throw away because they don't work. The interesting thing is, when you don't include slippage and commission, most ideas do work, but it's that grinding slippage cost where you have to pay the spread. That's what really gets you, and it turns most systems negative. And that's where a lot of people, when they don't count on slippage occurring, they get into trouble. So it can be very frustrating, and it's completely different than what probably a lot of you are used to, which is chart-based trading, where you know you might journal your thoughts and emotions, and that impacts your trading. That doesn't happen with algo trading. The rules are the rules. And it's not for everyone. If you're not a logical, analytical, kind of science-based thinker, probably it's not going to work for you. And that's okay. I mean, you know, it doesn't work for everybody, but the people who do the best with this tend to be engineers, scientists, doctors, accountants, and you notice who I didn't say. I didn't say artists and graphic designers and those kind of people. It's more the analytical type people that tend to succeed in algo trading, or tend to be able to handle it. So that's something to keep in mind. Some more disadvantages, and I'm giving you more disadvantages on purpose, because I want you to realize that it's not the rose garden that a lot of people will tend to think it is. So if you understand the disadvantages and you can still go to and say, I'm going to do it, that's a good hurdle to overcome, and it's better to do it up front, right? So it's very easy to develop a strategy the wrong way, and we'll talk about that. Of course, just because you have a good back test doesn't mean it's going to work going forward. And that's kind of it's kind of a paradox, because on one hand, algo traders rely on their back test to say something will work, but at the same time, it doesn't mean it will work. A lot of people continuously tweak, modify their strategy when they do algo trading. That's not good. Most people override it. I just mentioned the person who overrode the strategy and lost out. And I don't even know if he's still trading it, to be honest. I haven't talked to him. And it's not a set or forget type thing. It's not as bad now, but a few years ago it was really bad, where you'd always see these ads on the internet for robots, where you could just set it and come back next week and you'd have 20% more money in your account. That's not the way it works. Or at least it's not the way it works for me. Maybe I'm doing it wrong, but if you're trading futures, for example, you got to do rollovers. And if you're trading forex, there's going to be problems. There's going to be outages. Even if you're running on a server, private server, there's going to be all sorts of things going on. And so it's important for you to understand all that. All right, so that leads us into best practice number 2. So the first one, you have to really say, hey, do I want to do this? So maybe you look through all those disadvantages I just gave you and you're like, that's nothing, I can handle all that. Well, the second one, you got to learn your platform and learn how to program in it, right? Because you're going to be creating strategies. So you need a platform or a trading setup where you can both program the strategies, fully test them, automate them, and hopefully trade them live. I mean, whether that's one piece of software or that's a few different ones that you put together, that's what you need. Ideally, you probably want one that does all that for you. But that depends on your situation and what you're actually doing. If you are looking to do scalping, for example, probably most of the retail platforms won't work too well for you. And you might actually have to, I know people who've gone to the point of coding something maybe on a retail platform, but then converting it to something where they actually burn the code on a chip on a board that went in a computer that was co-located, right at in this case, it was a futures exchange, right at the exchange. So there's a lot of roads you can go down. So you're going to need to do some research and see what's best for you. See what you're comfortable with, especially if you've never really programmed. And how do you do that? Well, one good example is the magazine Technical Analysis of Stocks and Commodities. It's over in the US, but I know there's a lot of people around the world who read it. And what they have every month is they have one article where if you go to the back, it'll be written in a whole bunch of different languages, strategy code. So that's one way to look at different languages and see what might appeal to you. Because there's all sorts of different ways to program. So that's one thing you can do. So that was Technical Analysis of Stocks and Commodities magazine. I probably said that real fast. All right. So you've picked out your platform. Now you have to learn how to program, right? There's some people out there who say, well, I'll just hire a programmer. Well, remember a little while ago, I talked about how most of your ideas turn out to be bad. So think if you have to pay a programmer for every bad idea you have, you're going to spend a lot of money paying somebody to program garbage. And of course, you don't know it's garbage until you test it, so it's not the programmer's fault. But my point is, you should learn how to convert your ideas into actual trading rules. And again, there's plenty of good platforms out there to learn this development. And there's a lot of them that actually you don't even have to really know programming. As long as you can put little blocks together, it'll create the code you need. And that's really cool. So that will lead us to the third best practice. So once you've learned how to program strategies, you've actually got to develop them the right way. And so this is the development part, is once you program it, you got to know how to test a strategy the right way. And here's how most people do it. They take their code and they take all the parameters they have for their code, all the ranges, and put all their historical data, throw it in this big hopper, which is the optimization engine of the trading platform, because most trading platforms allow you to optimize. You run thousands of cases or millions of cases. I've heard of people running for weeks on end of optimization, and then they get the best parameters at the end. Oh, moving average of 4 with a stop loss of 3 times the average true range, plus a profit target of this, plus all these variables. Those are best. And then they go and they start trading. And hopefully some of you are laughing at that, like, who would do that? That's what most people do. That's what most people do. And it's wrong. It's just dead wrong. What I use is a trademarked approach that I came up with, which I call a strategy factory, but it's a lot different. So it starts out, after you have your goals, it starts out at your trading idea, but then runs through some testing, some limited testing, just to see if things are okay. Then does what I call what's known as walk-forward testing. Then I do some simulation. Then I let the strategy sit for a while, which is called incubation. Then I make sure it fits with my other strategies, and I do all that before I start trading. So contrast that to the person I just told you about back on this slide that just runs the optimization, gets the best parameters, and starts trading. It's a huge difference. And it shows up in your results. The market knows, I don't know how, but the market knows when you do over-optimize and you curve fit. And the way it tells you is when you lose money. It's weird. So obviously your performance goals, I'm going to go through these kind of quickly. You've got to have realistic goals, and it's got to fit you. That's the basic point there. And if you don't know up front what you want goal-wise, you probably will fail right before you start. And then once you have your goals, you come up with your trading ideas. And you can do a whole bunch of things. You can come up with ideas based on statistics or quantitative ideas. You can find ideas in magazines and books. The big thing, most people tend to prejudge ideas, and they'll say, oh, that's not a good idea. My approach is always to let testing tell you. It's objective, right? And I've found plenty of things that I didn't think would work that have worked. And the flip side is also true. I found plenty of things that I thought would work that didn't work. So you got to test it. Then you take your ideas, you turn them into strategy code. Again, you got to know how to program. And then you run a limited test. And so what that entails is not testing over your whole data set, all your historical data. I showed you earlier, 2001 to 2017. Don't test over all that. Just test over a little bit. And if the results don't look good, just move on to the next idea. People get into trouble when they start to chase and they start to force things to work. And I could take just about any system that anybody creates, and I can force it to work. That's not a good thing. You don't want to force things or chase. So you take a small piece of your data history, you run some quick optimizations. I look at the net profit out of the optimization, everything's good. Hey, that looks promising. Maybe I have something. I haven't tested on all the data, but maybe there's something there. So then I move on to Walkforward Testing. That's the next step. And before I talk a little bit about Walkforward, there's really four major ways to test a strategy. There's that traditional back test, which is what most people do, where they just over-optimize and just pick the best ones. There's something called out-of-sample testing, where you take 80% of your data and test it and leave the last 20%. So that's better. There's Walkforward testing, which is even better than out-of-sample and certainly better than traditional back testing. And then, of course, the best one is real money. And there is no test that is better than running a real money test, right? But it's also expensive, especially if you have a lot of bad ideas, which most of us do, or even good ideas that just don't generate enough money. It's a good test, but it's also pretty impractical. So I always step away from the best possible test and then go up to Walkforward testing. And so how that differs from a traditional back test, here's your traditional back test, which I'm just saying, hey, that's pretty dangerous, especially for somebody just starting out. So, be careful if you're going to do this. And I do a Walkforward testing where you actually take a small period of time, you optimize it, then you run those parameters on some unseen data and you keep going through it. And here's what it kind of looks like. And I won't explain this totally because this is obviously a huge topic. I could spend hours just talking about Walkforward testing and put you all to sleep. But you go down step by step down the left column. So the first time you would test in the blue, you would test from 2007 through 2011. You'd get a set of parameters that you determine was the best, and you'd run it on 2012 data. And then you'd step down and keep stepping. And then what you eventually do is you put together all the yellow sections, which are all out of sample, and you get an equity curve for it. So that's how you actually put it all together. Now, unfortunately, not all software, not all retail software out there does this. You can always do it by hand. I used to do this by hand. It's a great way to learn it, and that's what I encourage all my students. Hey, do it by hand at first. You'll really understand it, because a lot of people say, well, wait, you're still optimizing that. So that isn't really out of sample, and they don't really get it. Doing it by hand is tedious, but it will get you a much better understanding. And the other thing too is you can optimize these results. So it's not like this is a fail-safe way. I've seen people do Walkforward testing, and if they do it incorrectly, it's just as bad as some of those optimization things we talk about. And what you end up with Walkforward results, and this is hard, this is TradeStation, so this might be hard for you to read, but this is January 1st, 2006 to July 1st, 2006. You have a certain set of parameters, and then July 6th to January 1st of the next year, you have a different set of parameters. And so that's what Walkforward testing, you change, the parameters can change every period. And you end up getting what's an out-of-sample curve that looks like something like this. This is just an example. So again, is this good or bad? Well, you got to compare it to your goals. I will say this particular curve looks realistic. And you might say, well, this doesn't look that good. I want a straight line. Just remember, when you go to do back tests, if you get like a perfect looking equity curve, it's probably fake. That's my experience anyways. I could create in just about any trading platform, you give me about 5 minutes, I could create a great looking algorithm that has no basis in reality. It just looks great, but you couldn't trade it and make money with it, because there's ways to fool all these back test engines in pretty much every platform. So you want something that looks realistic, because it's not just a straight line. It's never going to be. Okay, so one of the pitfalls with Walkforward, remember I said it can be optimized. The way a lot of people do that is they run the Walkforward over and over again, and then all of a sudden what you thought was out of sample data is just in sample, so it's no good. Okay, so once you get through the Walkforward testing, you go on to Monte Carlo testing, which is just, it's really a math technique. I do it in a spreadsheet where you can just, it randomly picks trades and develops a whole family of equity curves based on your trading system. So it helps you to understand what kind of drawdown you could have gotten, what kind of expected profit, what kind of chances of ruin. Pretty cool. It's a good thing to do because you look at the out of sample equity curve, that's just really one possible history, right? I mean, that was the history, but you mix up the trades a little bit and your drawdown could be a lot worse, for example. So that's why I run it. I actually, if you go to my website, I think if you sign up for my email list, I give you a version of the same spreadsheet I use where you just put in trades over on the left-hand column and some other numbers in light blue. You hit calculate and it'll give you some statistics. And if you know Excel, if you're good with Excel and Excel macros, you can take this and do whatever, you know, the sky's the limit. You can do all sorts of neat things to it with position sizing and stuff. I usually use just the simple version because that tells me what I need to know. Okay, so you run it through Walkforward, you run it through this Monte Carlo testing, and everything looks good. It meets, I should mention, I don't have time to get into detail, but pretty much at every step along the way here, you have some criteria that's going to say this is good or not. It's kind of objective criteria, some values of parameters where it'll tell you to keep going, and if it doesn't meet it, you move on to the next idea. So the next one's incubation. A lot of people, most people don't do this. I spend a lot of time not doing it. It basically, once you create a strategy, you set it aside for a little bit, and then you go back and look at it maybe once a month and see if it still performs well. I surveyed people I work with if incubation has actually helped them, and over 80% of the people said it has definitely saved them a bunch of money by doing this incubation, because until you go real time, you could have cheated consciously or unconsciously, but you know, there's no way to know what tomorrow's data is. So that's why this is a good test. It's kind of a verification test. And here's an example of it. So I ended my development at the red line, and then I watched it for a while in real time, and here's what it did in real time. And if you draw kind of a imaginary straight line through the out of sample results, it looks like it's pretty much going the same slope. So it's performing about the same. So based on that, I'd say that, hey, this strategy is doing what it should. You know, what happens sometimes, especially for people who develop wrong, the strategy just goes down right past that red line to the right of that red line, and it just boom, collapses. That's what you got to watch out for. So you might also have to run a real money test to make sure your slippage and commissions are better. Here's an example of, so I made an assumption for a gold and a euro system, and I went back then, and when I started trading live, went back and reviewed those values, and I found out that, hey, I'm a little bit better in one market, worse in another, but I do this for just about every market, so I know I have pretty decent slippage amounts. And you could do that obviously with whatever you're trading. It's stocks, it's forex, and anything else. And the key with all that is just to remember that. And remember, we saw that disclaimer. Past performance is no guarantee of future results. That's a key. So remember that. Okay, so once you do the incubation, you say, okay, hey, this strategy is working in real time. I want to trade it. You got to see how it fits with your other strategies. You know, maybe it's a crude oil strategy. So take a look at your other crude oil strategy. Is it the same? Are they correlated? You know, how do you do position sizing? These are all questions you got to answer. So, you know, again, I use what I call a strategy factory, which I take ideas on the left side and test it, and what comes out the right side is the trading system. Well, usually what comes out is scrap, you know, because it doesn't work, but occasionally a trading system will get out of that factory, and that's what you're looking for. It's kind of a volume thing where you have to test a lot of things. So you do that over and over again, and you get multiple strategies. And I remember I mentioned that diversification was a big key. And you might say, well, why? Well, if the systems are not correlated, you have this where profits of the system add, but the drawdowns don't. Drawdowns will happen at different times for different types of strategies in different markets. And that's important to realize. And it's really kind of cool because, hey, my crude oil might be making new highs, but my mini S&P system might be failing. That's actually sort of what happened to me in early February when the US stock market kind of crashed. I got hit pretty hard on my mini S&P strategies because they all wanted to be long, and, you know, the market was falling. But my crude oil strategies made up for that somewhat because they were all short, and so they were all profiting. So it was kind of balancing out, and that's kind of what you look for. You know, it's not a free lunch because you do give up some high-end performance for it. You know, it's hard. You know, you're not going to be trading 10 or 20 strategies and get 1,000% return a year. You know, some people think that, but that's not realistic. But it's the way more professional traders trade because you tend to reduce your risk. Okay, so then you go on to real money operation. And as part of that, there's best practice number 4. You got to learn how to trade live. So here's an example. This is TradeStation. All retail platforms are basically the same that can do automation. It's basically like a 6-step, 6 mouse clicks basically, and your strategy can be running live. And most software is set up this way where it's pretty easy to turn on. But the key is you got to monitor your strategy. Once you do it, you just don't turn it on and let it go. And so many people think, hey, I'll just turn it on and no problem. Well, that is a problem. You want to see how it's performing relative to, say, this gray line, which is like your expected performance. You want to see how the actual results, which are here in dark blue, compared to what your back test, you know, your strategy engine says you should get. And if there's a big disconnect, you got to find out why. Are you not getting fills? Is your slippage worse than you expected? Is your automation cutting out? You know, what's going on? You want to monitor your strategy because strategies can go bad at any time. And just because something has worked for the last 10 years doesn't mean it's going to work tomorrow. You know, it could start going down tomorrow, and so you want to make sure you keep an eye on these things. I recommend you have a rule for quitting a strategy. You know, hey, if the strategy hits, you know, loses 5 weeks in a row, for example, and it's never done that before, maybe that's when you quit. It almost doesn't matter when you have the rule. it matters that you have the rule. Because you don't want your one strategy to bankrupt you. You know, you don't wait till all your money's gone. You turn them off at the proper time. And, you know, the key point is the one below, that they can and do stop working. Got to keep your emotions in check. You need discipline to do this. And, you know, I kind of think of them as children. For those of you with kids, you know, you do so much to help them grow up the right way and try to do the right things to them, but at some point, you got to let them go. You got to let them go off to do things, you know, explore the world. And that would be, for a strategy, it would be turning it on and letting it run. And you can't be what they call in the US helicopter parents. They're always hovering over kids and trying to run their life. I mean, I've heard of parents calling the bosses of their adult children at the place of work to yell at the boss. I'm like, who does, you know, people actually do that. That would be analogous to running a trading strategy, letting it go, but then overruling it all the time. You know, you don't do it. You need discipline, though, to not do it. It's hard. Gets easier over time, though. All right, so looks like we're right about on time. Do the book giveaway, and then I'll have questions afterwards. And thanks for all the questions. I see them popping up, and I'm trying not to read them, but I'll try to get through them all. Big thing, big takeaways today. Don't be intimidated by algos. You know, there's obviously those high frequency guys, but you're not going to play in their sandbox. You're going to be somewhere else. So, you know, don't be intimidated by it, but at the same time, spend some time and think about if you could actually do this. You know, do you feel comfortable programming 50 different strategies and testing them, only to find out a month or two later, you know, slowly you find out that none of them work? Because that can happen. You know, you might test your first strategy and it might work great, but chances are you're going to go through dozens or hundreds of strategies until you find something that works. And if that's for you, well, hey, I'll kind of push you off and say, get started. You know, I've given you steps to kind of get started and work through this. And just take your time and make sure you're doing things the right way. You know, don't fall for the easy trap, which is, hey, I'm going to optimize everything and then trade it right away. You know, I've done that where I've traded, tested late in the night, Sunday night, and then Monday morning I start trading it and immediately start losing money. Don't do that. Okay, so I'm going to do a book giveaway here real quick. I'm going to put up a question, just type an answer. It's going to be the fourth person with the correct answer. You can type it in the question box, and you will win the book. So just list one of those best practices. I gave you 4, just list one, and the fourth person to get it will actually win the autographed copy of the book. So just type it in the question box. Okay, 1, 2, 3, 4, we got it. Wow. That was quick. So let me go back, and we had, let's see, we had choose a trading platform, which was right. We had you got to want to algo trade. You've got to incubate. You've got to optimize the correct way. Those are all really good best practices. So Richard Angelis, you are the winner. So Richard, if you can, send me an email, and I think I have my email here right at the end, kdavey@kjtradingsystems.com. Just send me an email and tell me you won, or I might be able to get your email from the organizers, and I will send you out a copy of my book. Thanks for all the answers, everybody. There's tons of answers here. It looks like we had over 100 correct answers. So we should all be a winner and get a copy. Thanks. Yeah, Andrew, that's a good idea. Given the royalties I get on books, which are minuscule, I just can't afford to give everybody a book. I'd like to, though. So, all right. So with that, what I'm going to do is I'm going to start going back through questions. We have about 10 minutes. Hopefully I'll get to all of them. If I don't, it's not because I don't like you or I'm ignoring you or anything like that. But if I don't answer your question, there's my email address. You can just send me an email. I do answer my own emails, and I'm pretty good about it. So I will answer it. I just might not get to it today because we do have a ton of questions. So I'm going to start. I'm just going to go through the list way back. So just bear with me a minute. And just so somebody did ask about the recording. Yeah, it's going to be posted, and it's going to be available after the webinar. And somebody asked, where do I find the course, my Strategy Factory course? You can go to my website, kjtradingsystems.com. There's a menu item up at the top that's Strategy Workshop. You can learn all about it. Nicholas is asking, do I no longer manually trade? Right, for the most part, I just do all these algos. So sometimes I'll do some experimental stuff that's what I would consider like discretionary trading, but for the most part, I'm just running algos. Ricardo's asking, what's the difference between algo trading and quantitative trading? Quantitative trading is really, it might just be a difference of words, but quantitative trading, the way I would interpret it is, you know, you're looking at the numbers of past performance and using those to kind of build your strategies. But basically, it's kind of the same thing. Steve's asking, do I write my own source code? Yeah, for the most part, I do. But what you can do, pretty much every platform that's out there has tons of examples of things and tons of sample systems. And what I do a lot of times is that's where I start. I'll grab somebody else's idea and then go and modify it and add stuff to it. I do a lot of that. So, but you do want to know at least some of the basics of programming, or else it's going to get expensive. Isaac's asking about an algo-based hedging strategy. I don't do any of that necessarily. In the US, with forex, you're not even allowed to do what's considered a hedging strategy. But what I do, so let's just say I'm trading 3 euro strategies. The way I have it set up, well, one strategy might be long, one might be short, and one might be flat. Well, they all add up, and your net position is your flat. So as far as my broker is concerned, I'm flat. But as far as my strategies are concerned, they think they have positions. So I run kind of like a sum of all the strategies. So in effect, it's kind of like a hedging sometimes, because you do have strategies working against each other. And you might say, well, how do I make money doing that? Well, in the short term, if you had 2 strategies fighting, yeah, your net's going to be 0 if they're opposite. But over the long term, there's going to be times where they both trade in the same direction. And that's where you can actually make money as opposed to just be completely hedged. So that's kind of how I look at it, but I don't do hedging in the, you know, the way a lot of people think about it. Okay, Tio, who left, oh, okay, it's going to look at the recording. Richard, you watch the PC trade so that one can manage the risk, is never set and forget. I'm right. Yes, that's true. You still have to watch it to make sure things don't go haywire with the auto trading. Most platforms are set up to not allow that, but I've seen cases, I've heard of cases where people will have like 20 orders sent, and you know, so you got to be careful with that. Ricardo's asking the name of the magazine. That was Technical Analysis of Stocks and Commodities. Francisco I think in relation to Walkforward Testing, said this is a rolling horizon cross validation. I've never heard it called that, but you're probably right. So John is asking which is the one best platform for algo trading, and there really is. I don't think there is a best one. I mean, I have my own personal preference, but there's a lot to it, which I talked about earlier, and so you really want to investigate it and make sure you're comfortable with it, both from a programming point of view and an ease of development point of view, and also a broker point of view. If it's tied into your broker, you know, some of these retail platforms are set up so you can really only use one broker. Well, you want to make sure you trust that broker. You know, they might have the best platform in the world, but if you think they're undercapitalized and going out of business, maybe you want to use somebody else. Hamza, is asking if I'm still a full-time trader. Yes, I am. And I do some of this teaching on the side only because I have the time to do it. Nana is asking, is there a link between SQL and the programming language needed for algo trading? Yes, that depends on the platform you use, but a lot of them you can incorporate SQL type things and you know, do things via the platform API, and you can do all sorts of things. And Sam's asking if I develop intraday algos. Yes, not as many though. They're a lot harder to develop in my estimation. So I tend mostly to swing trading. Yang's saying, hey, if you decide to, you know, earlier I was talking about my S&P and crude oil systems. If you decide to want to retire the S&P, will the crude oil kind of cover it? Yeah, in effect, but I still want to have S&P systems. So probably what I would do in that case is just add them. Where can I get trading ideas to develop strategies? I talk a lot about this in my workshop, but you know, there are tons of ideas out there in books, magazines, the internet. You just got to look for them. And you know, just type in Google free trading systems and you'll get ideas. And you know, they might not work, but they might lead you. The best ideas are always the ones that you take something and then go and modify it. That's my experience. Position sizing, resources for that. I know Van Tharp, who was a market wizard, had a book called Definitive Guide to Position Sizing. That's a pretty in-depth book on it. Just be careful with position sizing because you can optimize that too. You know, there was a book a number of years ago that talked about a revolutionary position sizing technique. And as it turned out, it was just over-optimized, and it doesn't, you know, basically risk and reward are always kind of tied, so you don't get something for nothing. So be careful. Which chart software works best? Again, that's kind of a personal decision and based on what you use. Powell is asking, do I use systems that switch on based on the market type? You know, that's a Van Tharp type thing. And that's a great idea. The problem with it is usually by the time you determine your indicator says it's a bull market, it's already been a bull market for a while, so you come late, and then it'll tell you it's a bear market long after the bear market started. So that's a neat theory. It's hard to do. Which would have been the best computational language to build the algo? Again, that depends on what you're doing. I use TradeStation Easy language, but you know, there's a ton of stuff out there, different languages. And then Tristram has the same question, what's the best coding? Again, you know, take a look at the platforms out there and what their languages are, and hopefully you'll find something that appeals to you.